So if you are retired and you want to buy a home, how do you go about doing that? That's a great question. There's a couple of different options. There's a couple different ways we can slice this. So depending on what your situation is going to kind of determine how I would take that conversation. If you are retired and you are taking retirement income, right, we can do just a regular one that anybody would do if you had a job, right? If you're receiving, let's just throw some random numbers out, a couple $1,000s a month in Social Security, you've got a pension, maybe you have like an IRA or a 401k that you saved up when you were working that you take a regular monthly disbursement from. We can use all of that stuff as regular income, and you can qualify under just a traditional debt to income ratio program. If you don't, I've definitely encountered quite a few people who are retired and they don't actually draw a regular income. They might have a lot of money in the bank, substantial assets, but they just don't have a job, and they don't, they maybe get a little Social Security, but they're not like drawing any sort of regular monthly income. There are other loan programs called asset depletion loans, which are very popular for people who are maybe not working anymore. And essentially, what those do is they will take into account the amount of money that you have, either in stocks, bonds, mutual funds, just all your liquid assets, essentially. Um, and they will take that number, they will divide that out as if you were pulling a 60 months. So, like, let's say you have $6 million, just for example, right? They will take the total amount of assets that you have divided by 60, and that's the monthly income that they give you. So $6 million in that case, it's essentially the equivalent of you making $100,000 a month, which would support a pretty big mortgage payment. If you don't want to do that, there are examples where that wouldn't necessarily work, but somebody does have a substantial amount of assets, but maybe they also have a substantial amount of monthly debt. There's another loan program called ATR in full, where if you have enough money to cover the mortgage that you are taking out, 125% of that amount. So just again, to use nice round numbers, let's say that you want to take out $100,000 mortgage, after you make your down payment and everything, that you are going to have $125,000 left in your bank account. Your income is approved. That's the only calculation that's done. Take whatever you're borrowing times 1.25. As long as you have that amount of money, that's the only debt to income calculation that's done. It's called ATR in full. There are other more aggressive programs that are available that are based just on reserves too. So if you're in a situation where you don't have enough money to cover any of those situations, maybe you have money that you're expecting to receive, or who knows what the situation is. We have another loan program that is called a no ratio loan that's pretty popular with people who are retired that don't meet any of the you know aforementioned guidelines, where we will look at essentially credit score, down payment, and then a certain number of months of reserve. So it depends on credit score, but like if you have an excellent credit score and you have 25% down of your purchase price, then the only other requirement is that you have 6 months of monthly payment reserves in the bank. After you make your down payment, you make everything. So no income. We don't ask about job. We don't ask about income. We don't ask about anything like that. We just want to see you have 25% down. You've got 740 credit, and then let's say you got a $3,000 monthly payment in this example. Well, after you make all your payments, you need to have 18 grand in the bank left over when it's all said and done. As long as you have that 18 grand in the bank, your income, and debt to income ratio is approved. That's the only thing that's being looked at. So there's like a wide array of different options for people who aren't necessarily drawing an income. Obviously, the more documentation that you can provide, the better your terms are going to be. So out of those options, as you could probably imagine, the one that doesn't really ask for anything, that only requires you have 6 months of payment, those rates on that program are going to be much worse than a loan where you're showing enough money to cover the mortgage in full, or enough money to divide that out and do a proper debt to income ratio calculation. So generally, as a rule of thumb, like the more security and the more documentation that you can provide a lender to make them comfortable with your financial situation, like the more information they know about you and they can see kind of what's going on, the better your terms are going to be. Obviously, a regular debt to income conventional loan program is going to be the best out of everything. Um, but it's an option for sure. It's not really substantially worse, to be honest with you. When you're doing one of these asset depletion loans, the terms are not, it's not outrageous. So all I can say is, if you're questioning this, or I have a lot of people still that will ask me, and they're shocked when I tell them about this stuff. They're not aware that they could even get financing because they're retired and they don't have money, so they think paying cash is the only option for them for a house, I would encourage anybody who's in that situation to, to reach out to me or somebody else who's knowledgeable. Not everybody knows about this stuff, or is very well versed in it, but reach out, definitely reach out and we can go over your options with you.